In this lesson, we're laying another foundational pillar of our trading approach. This is extremely important, and you need to fully understand the concept I'm about to show you. Everything in our system and market understanding is built upon this. We're talking about supply and demand today. Supply and demand is a universal concept. It exists everywhere in life. Every market is driven by supply and demand. Supply is how much is available to sell, and demand is the buyer side, how much demand exists and how many buyers are there. If supply is greater than demand, the price falls. For example, if there's an oversupply of wheat, you as a buyer can choose where to buy it. You most likely pick the cheapest source, which leads to lower prices. If supply is lower than demand, the price rises. A relatable example: toilet paper during COVID. Lots of people were buying it, which made supply scarce and drove demand prices up. The last one: if supply is equal to demand, prices stay stable. This is exactly how the market we want to trade also work. Here's a visual to explain it better. In the market, we always have a buyer and a seller side. These are called bid and ask prices. These two parties need to be matched for price movements to occur. For example, here we have 240 people who want to buy something at 89 euros. We have 130 people who want to buy something at 99 euros. And we have 80 people who want to buy something at 100 euros. On the other side, we have 250 people who want to sell at a price at 101 euros and 400 people who want to sell at 102 euros. This creates a problem though. No trade happens here because buyers and sellers have different price expectations. If no one is willing to sell at 100 euros and no one is willing to buy at 101 euros, the market stays still. So no trade occurs when both sides stick to their prices. A trade can only happen if one side breaks their expectation. In real trading, for every buyer, there must be a seller, and vice versa. Otherwise, no transaction occurs. This is a key principle we'll be using to our advantage in our strategy. This means no trades occurs when both sides stick to their prices. A trade can only happen if one side breaks their expectation. In real trading, for every buyer, there must be a seller, and vice versa. Otherwise, no transaction occurs. This is a key principle we'll be using to our advantage in our strategy. We also need to understand that there are different types of buyers and sellers in the market. There are aggressive buyers and sellers and passive ones. In the early example, where no trade occurred, only passive buyers were involved. Passive buyers use limit orders only. They only buy or sell if their set price is hit. Aggressive buyers or sellers use market orders. They buy or sell immediately, even at the worst price. I will show you the order types here again. Market order. You enter a trade immediately at the best available price for you. This is aggressive. Limit order. You enter only if the price reaches your specific level. This is passive trading. For example, here, the price moved up, it moved down, it hit the red line there, and that's exactly where our limit order went into the market, and in this example, bought something. The last order type is stop order. In this example, we have a long market, we move up, we move down, and we move over the previous high. As soon as we move over the previous high, the stop order activates, and it buys when we move over it. So this is also a kinda aggressive type of order, but for our strategy, this is less relevant. So what does this mean for us in real chart? The chart is filled here with passive buyers and sellers, only limit orders. To push price up, aggressive buyers must first buy through all available sell orders at current levels. Only then can the price rise. In this example, we need to buy up the 250 people who want to sell at 101 euros and the 400 people who want to sell at 102 euros. If we buy all of these positions up, the price will move up. Also, the buyers, they need to keep buying aggressively to continue to move upwards until new sellers show up. Passive buyers can't move the market. They can only slow down and drop. Only aggressive buyers or sellers can truly move the market. And that's what we'll be using in our strategy to determine where the big players move their positions into the market. See you later.